Good evening, this is your James AG. If you're here, you're not looking for hype. You're looking for structure, data, and a community that actually verifies what it hears before repeating it. Tonight, we're looking at a market move that has every channel screaming moon again, and my job is to walk you through why that noise is exactly what you should ignore. Silver just rocketed 22% in 24 hours. 22%, from a $65 low to $78 spot. Bitcoin clawed back $11,000. US stocks added $1 trillion in market cap. The Dow hit a new all-time high. If you're watching this on February 7, 2026, you just witnessed one of the most violent risk-on reversals in recent memory stocks, metals, and crypto, all reversing simultaneously after weeks of coordinated correction. But here's what separates signal from noise. This happened while physical silver supply indicators were already flashing red. London lease rates at 6.1%. Chinese exchange vaults draining 73 tons in a single day, down 90% since 2020, projecting near empty within weeks. And a March COMEX delivery crisis looming with 429 million ounces of open interest against barely 103 million registered. So the question isn't whether this bounce feels good. The question is this the bottom? Or is this the paper market doing what the paper market always does, creating fakeouts that separate leveraged traders from their capital? Before we go deeper, I will never DM you first. I will never ask you for money. I will never offer to manage your capital or pitch you a special allocation. Anyone doing that is an impersonator, and this channel has been targeted aggressively. If someone contacts you claiming to be me with an investment opportunity, report and block immediately. Your protection is your responsibility. If you've been in this community for the long haul, drop OG in the comments. I want to see who weathered the drawdown with discipline. And tell me where you're watching from, what city, what country. The algorithm needs to know this isn't bot traffic, and I need to know who actually holds physical versus who just watches the price ticker. Here's the dislocation that should be front-page news but isn't. The Shanghai Gold Exchange and Chinese wholesale vaults have lost 90% of their silver stockpiles since 2020. 90%. 73 tons vanished in a single day this week. Project that forward, and you're looking at empty vaults within weeks, not months. Meanwhile, March 2026 COMEX silver delivery contracts stand at 429 million ounces. Registered metal available for delivery, approximately 103 million ounces. If delivery demand runs high, and with Chinese physical this tight, why wouldn't it? The exchange is staring at a structural shortfall that paper price manipulation cannot print away. This isn't a trading call. This is a system credibility question. And tonight we're going to walk through the data, the mechanics, and the risks, bullish and bearish, that actually matter. Stay sharp. The bounce is real. Whether the bottom is, remains to be verified. Let's strip away the price action and look at what the infrastructure is actually telling us. These aren't opinions, they're exchange-reported figures, inventory flows, and positioning data that institutional desks watch while retail chases candlesticks. Silver lease rates have spiked to 6.1%. This is not normal contango behavior. When metal becomes this expensive to borrow, it signals either acute tightness in available physical or strategic withholding by large holders. In a properly functioning market with surplus supply, lease rates sit near zero. 6% screams locate risk, the possibility that promised metal cannot be physically sourced for delivery. The drawdown here is unprecedented. Chinese exchange stockpiles have collapsed 90% since 2020. The recent 73-ton single-day drain projects vault exhaustion within weeks, not quarters. This matters because China represents both the world's largest industrial silver consumer and, increasingly, a strategic accumulator. When their visible inventories vanish, two possibilities exist. Either industrial demand has absorbed everything, or metal has moved to non-reporting state reserves. Either way, the paper price is diverging from the physical reality on the ground. Registered silver metal actually available to satisfy delivery stands at approximately 103 million ounces. Open interest for March 2026 delivery contracts, 429 million ounces. This 4-1 structural deficit isn't new, but it's tightening. The exchange relies on eligible metal converting to registered status, but that conversion requires willing sellers in a market where above-ground stockpiles are fragmenting nationally. Commercial positioning has shown covering behavior, but open interest structure remains concerning. Low gold open interest relative to historical norms suggests either risk reduction by major players or preparation for volatility expansion. The concentration ratios, How few hands control how many contracts deserve scrutiny in any delivery-stressed environment. Premiums in Indian physical markets have remained elevated, indicating that even with recent price volatility, import demand and retail accumulation haven't collapsed. Indian buying often serves as a floor mechanism. When domestic premiums compress, it signals demand destruction. We aren't seeing that yet. Normally, tight physical supply in London or Shanghai would trigger arbitrage flows, metal moving from surplus regions to deficit regions, paper positions converging with physical reality. That convergence isn't happening. Why? First, national stockpiling has fragmented the global pool. Metal that might have traded freely now sits in strategic reserves with no price incentive sufficient to release it. Second, logistics and refining bottlenecks mean even willing sellers face delivery timelines that miss contract windows. Third, the paper market's futures, ETFs, swaps have grown so large relative to deliverable physical that arbitrageurs cannot source enough metal to close the gap. The tail wags the dog until the dog breaks. This is the core tension your James Ag tracks relentlessly. The price you see on screens reflects derivatives trading leveraged bets, algorithmic flows, risk parity rebalancing. The value of silver as strategic input solar, defense, electronics, monetary reserve is set by physical availability for industrial delivery. When lease rates hit 6% while paper prices bounce 22%, you're watching that divergence in real time. One market is signaling abundance through volatility. The other is signaling scarcity through cost of carry. For perspective only, not positioning advice. RSI bounced from deeply oversold territory, but on this time frame, momentum readings often lag structural turns by weeks. Price has reclaimed short-term averages, but remains in a broader downtrend structure on weekly timeframes. The $65 low violated prior support. Whether this recovery holds above $75-80 zone determines trend integrity. Lagging span still below price action. Cloud structure suggests resistance ahead if this is merely a relief rally within a larger correction. The bounce occurred on expanding volume, but volume alone doesn't distinguish capitulation buying from genuine accumulation. Watch for volume contraction on any retest of the lows. That would signal supply exhaustion. The technical picture supports unconfirmed bounce more than confirmed bottom. Structure takes time to repair. 22% in 24 hours is emotion. Emotion is not foundation. Every figure cited here, LBMA lease rates, SGE withdrawals, COMEX registered eligible splits, CO-T positioning, is publicly verifiable through exchange releases and regulatory filings. Do not take my word for it. Verify. The habit of verification is what separates this community from the hype channels. Let's step back and connect what we've established. We have a 22% price bounce occurring simultaneously across stocks, crypto, and metals, a coordinated risk-on reversal after weeks of correlated selling. We have Chinese physical inventories collapsing towards zero. We have London lease markets pricing scarcity at 6%. And we have a March COMEX delivery window with 4 times more paper claims than registered metal available to satisfy them. The macro narrative emerging isn't silver to the moon because inflation. It's structural supply deficit meeting paper price suppression that's losing effectiveness. The leverage flush we just witnessed, silver to $65, Bitcoin testing lower ranges, margin calls across the board. That wasn't demand destruction. That was weak hands being separated from positions before the physical market tightens further. The system is showing stress fractures. The question is whether this bounce repairs them or masks deeper instability. Silver and gold are being repriced not as commodities, but as strategic assets, inputs to energy transition, defense systems, and national reserve diversification in a fragmenting global order. The paper markets were built for a world of abundant, freely flowing metal. That world is ending, but I promised you balance. And balance means taking the bearish case seriously, not as FUD to dismiss, but as risk to respect. If global manufacturing contracts sharply, industrial silver demand, 50% of total consumption, could fall faster than supply tightens. Solar and electronics are growth stories, but they're not recession-proof. A synchronized global downturn would pressure offtake even with tight physical availability. Exchanges respond to volatility by raising margin requirements. We've seen this before. Price spikes trigger risk management protocols that force liquidations, creating self-reinforcing downdrafts. A 22% bounce in 24 hours is exactly the kind of move that prompts exchange intervention. If margins rise, leveraged longs become forced sellers regardless of fundamentals. The DXY remains structurally supported by relative growth differentials and safe haven flows. A resurgent dollar pressures all dollar-denominated commodities, including silver. If the Fed maintains restrictive posture while other central banks ease, the currency headwind intensifies. While silver's industrial applications are currently irreplaceable in many contexts, sustained high prices accelerate thrifting and substitution research. This is a multi-year process, not a quarter, but it caps the upside thesis if prices remain elevated. The paper markets exist to manage price. Commercial entities with deep balance sheets can absorb delivery stress longer than speculators can absorb margin calls. The 4:1 open interest to registered ratio has persisted for years. The imminent delivery crisis thesis has been wrong before. Hubris in assuming this time is different is a known failure mode. Silver's volatility profile, historically double gold's, destroys capital faster than fundamentals rebuild it. The miners that offer leverage to metal prices also offer leverage to downside. If this bounce is a relief rally within a larger bear market, buying here is catching a falling knife with no handle. The transcript notes Bitcoin's historical drawdowns of 70–80% from peaks. If BTC revisits $38,000 as part of a broader crypto deleveraging, risk assets including silver face correlation selling. The digital gold narrative has created price linkage that didn't exist a decade ago. Silver's fundamental tightness may not matter if macro liquidations dominate. These aren't straw men. Each has historical precedent. Each has destroyed capital in recent memory. The 2011 silver spike to $50 followed by a decade-long grind lower is living memory for many in this community. The 2020 margin hikes that crushed legitimate hedgers alongside speculators. The 2022 transitory inflation narrative that punished commodity bulls. Dismissing bearish arguments because you want the bullish thesis to win is how you become exit liquidity for smarter hands. Respect the downside. Build positions if you build them assuming these risks materialize, not assuming they won't. The structural tightness in physical silver is real. The paper market's fragility is real. But timing is uncertain, and the path between tight supply and higher price can include violent drawdowns that shake out everyone except those who sized appropriately and verified their sources. Now let's reframe those bearish factors, not to dismiss them, but to place them in context. Every risk just outlined is a delay mechanism, not an invalidation of the structural thesis. Recession risk? It accelerates monetary response that ultimately benefits hard assets. Margin hikes? They flush leverage, leaving stronger hands to absorb the eventual physical squeeze. Dollar strength? Relative to what? Currencies with worse structural problems? Technological substitution? A 5 to 10-year horizon, while current supply deficits are measured in months. The paper price suppression that kept silver range-bound for decades required abundant, freely flowing physical metal. That condition no longer exists. Chinese vaults didn't drain 90% because of speculation. London lease rates didn't hit 6% because of technical trading. These are inventory stress signals in a system designed to hide inventory stress. Consider the demand vector that's barely priced in: AI data centers, solar expansion, defense electrification, grid hardening. These aren't cyclical industrial offtakes. They're structural, national priority allocations. When the Pentagon and Beijing are competing for the same silver stockpiles, the commodity framing becomes obsolete. This is strategic material in a fragmenting world order. Geopolitical stockpiling amplifies everything. Nations aren't accumulating paper claims. They're moving physical metal within borders, out of reporting visibility, into strategic reserves. This fragmentation removes supply from the global pool that paper markets assume is accessible. The 429 million ounces of March open interest assumes metal can be located. The 6.1% lease rate suggests otherwise. Miners offer leverage to this dynamic with the caveat that leverage cuts both ways. But at these input cost structures and reserve grades, sustained higher prices flow disproportionately to bottom lines. The earnings expansion potential is mathematical, not speculative. If the metal price holds, and if costs don't inflate proportionally, you weathered the drawdown. Your metal is still in your possession, unencumbered, unhypothecated. The lease market tightness validates your strategy. Continue verifying custody, insurance, and geographic diversification. Don't let the 22% bounce tempt you into trading what you can't replace. If you're operating in paper markets, risk management isn't optional. It's survival. Position sizing should assume 30–40% drawdowns within broader uptrends. Stop losses are admission tickets, not failure confessions. The current bounce lacks structural confirmation. Treat it as relief until volume and time validate it as accumulation. The M2 adjusted silver chart hasn't changed its message. The purchasing power preservation case remains intact. Short-term volatility is the tax you pay for long-term optionality. Dollar cost average, verify your sources, and ignore the hype channels that scream at every 5% move. London lease rates, Chinese vault drains, and COMEX delivery stress are converging indicators of a system pricing scarcity for the first time in decades. The paper bounce doesn't fix this. It highlights the disconnect. Recession, margin compression, and dollar strength can delay the repricing, but they cannot print silver into existence. Structural deficits persist regardless of macro headwinds. Position for the timeline, not the headline. Every data point cited here is checkable. Every risk outlined here is manageable. The community that verifies and sizes appropriately will still be standing when the leverage flush victims are liquidated. Here's what keeps me up at night. If March 2026 delivery demand exceeds registered availability by even 20%, and exchange officials respond with cash settlement or force majeure rather than physical delivery, what happens to the credibility of the entire paper pricing structure? And if that credibility fractures, what is the price discovery mechanism that replaces it? And how violent is the transition? We may find out sooner than the market is pricing. Verify everything I've said. Check the LBMA lease data. Pull the SGE withdrawal reports. Compare COMEX registered versus eligible for yourself. This channel exists to build independent researchers, not dependent followers. If this analysis added value, subscribe. The algorithm suppresses this content precisely because it discourages emotional trading. Your engagement is how we reach the people being harvested by hype channels and impersonation scams. Invest with logic, not hype. This is your James Ag. Stay sharp, stay skeptical, and keep your metal close.